Hi, I'm James. Welcome to Sketching Finance, where we simplify finance through visual storytelling. Welcome back to Day 5, where we sharpen your financial defense by building the financial firewall, also known as the emergency fund. In the last 4 days, we sharpened your sword of compound interest and gave you the map of budgeting. You feel ready to attack the market, focused only on growth and getting rich. But what happens when life attacks you from behind? A sword cannot stop an arrow aimed at your back. Without a shield, one single event, a job loss or an accident, can wipe out years of progress instantly. Today, we build your defense, the financial firewall, the emergency fund. In professional finance, we call this the perfect storm. It is a scenario most investors ignore until it is too late. Imagine a recession hits, the stock market crashes 40%, and your $1 billion portfolio drops to $600 million on paper. Simultaneously, the bad economy causes your company to cut staff. You lose your job or face a 50% income cut. Now, you need $50 million immediately for basic survival. But your bank account is empty. You have no cash. You are forced to look at your investment account, the only place where money is left. This is the tragedy of the realized loss. You are forced to sell your stocks at the absolute bottom. To get $50 million cash, you must sell shares that originally cost you $83.3 million. You just lost $33.3 million permanently. When the market recovers, you no longer hold those shares. You have lost your position forever. Now, look at case B. With an emergency fund, you simply withdraw $50 million from your savings. You do not touch your investments. 6 months later, the market recovers and your portfolio returns to $1 billion. You lost nothing. Let's look at the brutal math of recovery. Why is selling at a loss so dangerous? If your asset drops 50% from 100 down to 50, do you need a 50% gain to get back to your original capital? No. To go from 50 back to 100, you need a 100% return just to break even. The emergency fund buys you time, allowing your investments to heal themselves naturally. Investing is 20% technique and 80% psychology. Let's look at your brain's chemistry. When the market crashes, your amygdala, the fear center, triggers a fight or flight response. Without cash, you panic and sell everything for safety. This is an irrational, instinctive action. But having 6 months of cash tells your brain, survival is guaranteed. This keeps your prefrontal cortex, the logical center, in control. You stay calm while others panic. Scientists have proved that worrying about money literally lowers your IQ. This is the bandwidth tax. You cannot think logically because your brain is busy worrying about tomorrow's bills. In Maslow's hierarchy, if your foundation of survival is shaking, your investment layer will collapse. An emergency fund pours concrete into that foundation. Your investment now belongs to the high-growth layer. It releases your cognitive bandwidth, allowing you to see the long-term cycle instead of short-term pain. This fund provides a massive mental ROI. It gives you the power of indifference. Without savings, you are a victim. You accept low pay because you are desperate for a paycheck. With 12 months of cash, you have walk-away power. You can say no to bad deals and toxic bosses. This confidence makes you look like a leader. It contributes 80% to your major career breakthroughs. Cash doesn't just earn interest, it buys freedom, the soil where your talent can bloom. So, how much is enough? In professional consulting, we never give a random number. This is highly personalized. We use a multivariable risk assessment to find your safety number. The rule is simple. The higher your life risk, the bigger your fund must be. We analyze 4 key variables: job stability, dependence, fixed costs, and health. Let's assess where you fall on this risk spectrum. Are you a government employee or a teacher? Your job is safe. You can aim for 3 months. Are you in IT or healthcare? You can find a new job in 30 days. 3 months is enough. But if you are a freelancer or a small business owner, your income is unstable. Aim for 6 to 12 months. High-level executives also need 9 months, as the hiring process for senior roles takes a long time. If you are the sole earner, your risk is high. If both spouses work, you are safer. If you are single or a dink couple with no kids, your shield can be thin. But if you are the sandwich generation, caring for kids and aging parents, you need 9 to 12 months. Do you have a large mortgage? The bank demands payment even if you are unemployed. Your fund must include monthly debt payments, not just food money. Health insurance transfers risk. Without it, your emergency fund must also be your medical fund. Many feel regret keeping cash at 5% interest while the market pays 12%. Let's calculate the cost. On 100 million, you lose 7 million a year, about $580K a month. Don't see it as lost profit. See it as a portfolio insurance premium. You pay for car insurance and feel happy if you don't crash, right? You pay 7 million to avoid losing 300 million in a crash. This is a bargain. To minimize costs, we use the layering strategy. Tier 1, flash cash. This is for disasters at 2 a.m., like a medical emergency or a broken pipe. Keep 5 million in physical cash at home and the rest in your checking account. The interest is near zero, but the access is instant. Its goal is speed, not profit. Tier 2, the flexible buffer. This is for survival during the first weeks of unemployment. Use fintech apps or digital banks that offer 5 to 6% interest with instant withdrawal. You can get your money back within 24 hours. Limit this to 100 million to minimize platform risk. Online deposits for 1 month with auto rollover are also a safe choice. Tier 3, the strategic reserve. This protects you from the 3rd month of unemployment onward. Use the savings laddering strategy. Split the money into several small deposits maturing at different times. This earns the highest interest, matching inflation. You protect your purchasing power and can still withdraw everything in 15 minutes. Before touching 1 cent, you must answer yes to 3 questions. Is it unexpected? A wedding gift is predictable. A sudden appendicitis is not. Is it urgent? A broken pipe flooding your house is urgent. A new iPhone is not. Is it essential? Is it necessary for your health, safety, or income? A cheap investment opportunity is never an emergency. Do not touch your shield. What about things you know will happen, like car maintenance or an old fridge? You need a sinking fund, a planned fund for predictable expenses. The emergency fund is for the unknown. The sinking fund is for the known. Set aside 1 to 2 million monthly for life maintenance. When your car breaks, pay from this fund. Your financial firewall remains untouched. Here is the standard protocol for building your fortress. Step 1. Build a small starter fund to stop you from borrowing more when emergencies hit. Step 2. Kill bad debt. A 30% interest rate is a guaranteed loss you must fix first. Step 3. Complete your full shield of 3 to 6 months. Step 4. Now you have the right to attack. Start investing in stocks and assets. Beware of lifestyle creep. As you spend more, your 60 million shield might only cover 3 months. The rule is, your fund tracks your expenses, not your income. Review your fund immediately after buying a home, getting married, or having a child. If life is stable, audit your numbers every 6 months. Use your raises to top up your fund first before upgrading your lifestyle. Pulling 50 million today for a repair means losing 818 million in 20 years due to lost compounding. The emergency fund is the bodyguard of compound interest. It takes the hits so the master, your portfolio, can grow undisturbed for 20 years. Without it, your snowball never reaches the tipping point where wealth explodes. It buys you the ultimate asset, freedom. And freedom is where your talent blooms. You have completed the defense module. Your fortress is built, liquid, and smart. Now that the fortress is secure, it is time to open the gates and attack. Tomorrow, day 6, the architect of wealth. We will build your asset allocation. Are you a conservative or an aggressive investor? Answer the quiz tomorrow. Subscribe now and don't miss day 6.